So you decided to invest in multifamily real estate, but you don't know where and how to get started. I don't blame you because I searched for it myself and I couldn't find any video simply explaining how. Don't worry, in this video, I'll share with you only three steps you need to get started in multifamily investing. Hey friends, my name is Adrian and welcome back to the channel, where you invest in communities as a community. Let me guess, you've done your research, read a bunch of books, listened to podcasts, and attended local meetups and conferences, yet you still feel lost. You know how I get it? Because I was in your shoes once. Every answer I got felt like the right answer, so I was doing all the right things. And that's the problem because I was all over the place. All the answers led me in many different directions. I didn't realize that each answer has its own time and place. Without further ado, the first steps is learning how to qualify or identify a good operator. If you're an avid follower of this channel, we cannot stress enough the importance of only investing with good and experienced operators. So what makes a good operator? And what questions should you ask them? I've summarized it in a two-step framework to filter out operators. One is the experience filter, and the second is the personality filter. The experience filter is easy to spot because the information is objective. So some questions you can ask are, how long have you been an operator? How many properties have you invested in the area? What are the markets you are currently invested in? I made a detailed video on the questions you need to be asking and the reasons behind the questions. I'll link that video in the description below. The second filter is more difficult to identify. For one, because it is subjective. Each of us is unique, so depending on your own personality type, what you value in a person will be different from what I look for and what someone else is looking for. The second reason why it is difficult is because it will take time. The personality filter won't work after only talking to the operator once or twice. Okay, maybe if they have a loud personality, then the filter will work for you right away. But more often than not, it will take multiple face-to-face interactions. And that's okay. If you can identify an operator that you know, like, and trust, that covers close to 90% of the work you need to do as a passive investor. Because the remaining 10%, which we'll cover later in this video, is just verifying what they're saying. If there is one thing you take away in this video, spend majority of your time getting to know the operator. Don't worry about the deals. There will always be deals. In fact, even if an operator finds a great deal, bought at a discount, and has a lot of avenues to raise its value, you can still lose money on that deal if the operator is inexperienced. Whereas if the deal is an average deal, but in the hands of an experienced operator, they can find ways to make that deal very lucrative. That is a segue in the second step in getting started with multifamily, and that is learning how to identify good deals. A simple way to do this is a top-down, bottom-up approach. Let's start with the top-down portion. First, look into the area where the property is located. Who are the major employers in the area? What is the median income? What is the year-over-year population growth? What is the crime rate of the neighborhood? That sort of information is what you're looking for in the top-down approach. Whereas the bottom-up approach is looking at the financials before looking into the structure of the building. So the questions you can ask are, what are the units currently rented at? How much can we raise the rent? What is the expense ratio? This approach aims to help you save time and eliminate deals faster. For example, if an operator offers you a deal in a high-crime area, if that type of deal doesn't match your risk profile, then you can pass on that deal. No need to look at the financials or how much you'll make in the deal. Side note, I'm not saying deals in a high crime area are a bad thing, because deals with higher risk profile should provide higher returns. So that all depends on your goals and your tolerance for risk. Now, when it comes to underwriting, let me just say this one point before we move to the last step. A lot of investors get hung up on the numbers. Now, you can do as in-depth of an analysis as you like, but at the end of the day, they're all projections into the future. That is why your time is better spent by doing step number one. Okay, so the last step is learning what a good deal structure looks like. You can find this outlined in the Private Placement Memorandum, or PPM. It is a very long document that discloses everything from the risk to the reward. So let me narrow down your search. You need to pay attention to these four things. One is the capital stack. I like to think of this as the order of who gets paid first. Second is the sources and uses of funds. This section breaks down where are the funds coming from and how are they allocated in the deal. Third is the waterfall structure. If the capital stack shows the order of who gets paid first, the waterfall structure explains how much everyone is getting paid. And fourth is the fees that operators are charging. What you're looking for is the market rate for those fees, and if the fees are in alignment with investors' interest. If it's the first time you're hearing about the terms I just mentioned, don't worry, I made an in-depth video going over the waterfall structure. I'll link that video in the description below. That said, if you're looking to get cash flow as a passive investor, the biggest factor influencing this is what we call the preferred return. And you'll see several investment classes that have this or just a straight split. So if you're wondering what is the difference and which one is best for you, go ahead and watch this video next. You'll be surprised because not a lot of operators will explain it the way Perry will.